For better control over the organization, management responsibility and authority to various departments of persons. These departments of persons are known as responsibility centers and are responsible for performance in terms of expenditure, revenue, profitability, and return on investment. There are 4 types of responsibility centers. 1. Cost centers. 2. Revenue centers. 3. Profit centers. 4. Investment centers. Let us discuss in detail each of these responsibility centers. 1. Cost centers are held responsible for incurrence of cost. The performance of this responsibility center is measured against predetermined standards or budgets. There are 2 types of cost centers. A. Standard cost center. B. Discretionary cost center. A. Standard cost center where output is measurable and input required for the output can be specified. The actual cost is compared with standard cost to find variance. B. Discretionary cost center, the cost center whose output cannot be measured in financial terms. Examples: research and development department, advertisement department, etc. 2. Revenue centers. Responsibility centers which are accountable for generation of revenue for the entity. Example: sales department. 3. Profit centers, the Sharda responsibility centers which have both responsibility of generation of revenue and incurrence of expenditure. Example: decentralized branches of an organization. 4. Investment centers, these are the responsibility centers which are not only responsible for profitability but also has the authority to make capital investment decisions. Performance office responsibility centers in terms of return on investment. Example: public sector undertaking of central government. 4 Major limitations of cost accounting. Limitation of cost accounting. 1. Expensive. Expensive because analysis, allocation and absorption of overheads required considerable amount of additional work and hence additional expense. 2. Requirement of reconsideration, shown by accounts required to be reconciled with financial accounts to verify their accuracy. 3. Duplication of work, the organization required to maintain financial account as well as cost accounts. Hence it leads to duplication of work. 4. Inefficiency, costing system itself does not control cost. Can be classified on the following basis. 1. By nature or element. 2. By functions. 3. By variability or behavior. 5. By controllability. 6. By normality. 7. By cost for managerial decision making. Let us discuss each elements of cost in detail. Element of cost. Cost is primarily divided into 3. A. Direct material cost. B. Direct employee cost. C. Direct expenses. The above costs are further divided into following. 1. Direct material, material which are present in the finished product economically identified in the product are called direct material. However, in some cases images may be direct but it is treated as indirect, because it is used in small quantities. 2. Direct employee cost, labor which can be economically identified or attributed wholly to a cost object is called direct labor. Example: engaged actual production of the product or in carrying out necessary operation for converting the raw material into finished product. 3. Direct expenses, all expenses other than direct material or direct labor which are specially included for a particular cost object and can be identified in an economically feasible way. Example: inward transportation charges. 4. Indirect material, material which do not normally form part of the finished product are known as indirect materials. Examples: stores such as lubricant, cotton waste, used for maintaining machines and buildings. 5. Indirect labor, labor cost which cannot be allocated but can be apportioned to or absorbed by cost unit for cost centers are known as indirect labor. Examples: foremen, supervisors, etc. 6. Indirect expenses, expenses other than direct expenses are known as indirect expenses, that cannot be directly, conveniently, and wholly allocated to cost centers. Examples: telephone, rent, insurance, etc. 7. Overheads, aggregate of indirect material cost, indirect labor cost and indirect expenses. Into which word can be subdivided are as follows. Production or works overheads, indirect expenses which incurred in the factory and for the running of the factory. Examples: factory rent, power, etc. Administration overheads, indirect expenses related to management and administration of business. Example: office rent, telephone, etc. Selling overhead, indirect expenses incurred for marketing of a commodity. Example: advertisement expenses, commission to salesperson. Distribution overhead, expenses incurred to dispatch the goods. Example: packing and loading charges. Classification costs are divided according to the function for which they have been incurred. 1. Direct material cost. 2. Direct employee cost. 3. Direct expenses. 4. Production/manufacturing overheads. 5. Administration overheads. 6. Selling overheads. 7. Distribution overheads. 8. Research and development cost, etc. According to behavior classified into 3 groups: biz, fixed, variable and semi-variable. A. Fixed costs. These are the costs which are incurred for a period and does not change based on level of activity. Examples: rent, insurance, etc. B. This cost and to vary with the volume of activity result in increase in the variable cost and vice versa. Example: cost of direct labor, cost of direct material, etc. C. Semi-variable cost. These costs contain both fixed and variable components and are partially affected by fluctuation in the level of activity. Examples: telephone bills, gas and electricity bill, etc. Methods of segregating semi-variable costs into fixed and variable cost. A. Graphical method. Under this method the following 6 steps are followed. 1. A large number of observations regarding the total cost at different levels of output are plotted on a graph with output on the x-axis. 2. The total cost is plotted on y-axis. 3. Then, by judgment, a line of best fit which passes through all or most of the points is drawn. 4. The point at which this line cuts the y-axis indicates the total fixed cost component in the total cost. 5. If a line is drawn at this point parallel to the y-axis, this indicates the fixed cost. 6. The variable cost, at any level of output, is derived by detecting this fixed cost element from the total cost. B. High points and low points method. Under this method the difference between the total cost at the highest and lowest volume is divided by the sales volume at highest and lowest volume. The quotient thus obtained gives us the rate of variable cost in relation to sales value. C. Analytical method. Under this method, an experienced to cost accountant tries to judge empirically what proportion of the semi-variable cost would be variable and what would be fixed. D. Comparison by period or level of activity method. Under this method, the variable overhead may be determined by comparing with the amount of expenses at those levels. Since the fixed element does not change, the time with the help of the following formula. Change in the amount of expense divided by change in the quantity of output. E. Least square method. This is the best method to segregate semi-variable cost into its fixed and variable components. This is a statistical method and is based on finding out a line of best fit for number of observation. The method uses linear equation y equals mx plus c, where m represents the variable element of cost per unit, c represents the total fixed cost, y represents the total cost, x represent the volume of output. The total cost is thus split into its fixed and variable element by solving this equation. Cost may be classified into controllable and uncontrollable costs. A. Controllable costs, the cost that can be controlled, typically by a cost profit or investment center manager, is called controllable cost. For example, direct cost comprising direct labor, direct material, direct expenses, and some of ORCIDs are generally controllable by the shop-level management. B. Uncontrollable cost, cost which cannot be influenced by the actions of a specified number of undertaking are known as uncontrollable costs. For example, head office expenditure allocated to a branch is not controllable by the branch. On the basis of normality, cost can be categorized as follows. A. Normal cost: it is the cost which is normally incurred at a given level of output. B. Abnormal cost: it is the cost which is not normally incurred at a given level of output. By costs for managerial decision making. A. Predetermined cost: a cost which is computed in advance before production or operation starts on the basis specification of all the factors affecting cost, is known as a predetermined cost. B. Standard cost: a predetermined cost, which is calculated management expected standard of efficient operation and the relevant necessary expenditure. C. Marginal cost: the amount at any given volume of output by which aggregate cost are changed, if the volume of output is increased or decreased by 1 unit. For example, company manufacturing heavy vehicle incurred total cost of rupees 150 million for the manufacture of 100 units. If the company manufacture additional 1 unit at a cost of rupees 1.3 million, then its marginal costing is rupees 1.3 million. D. Estimated cost: Kohler defines cost as the expected cost of manufacture, or acquisition, often in terms of a unit of product computed on the basis of information in advance of actual production or purchase. E. Differential cost: it represents the change in total cost due to change in activity level, technology, process, or method of production, etc. F. Imputed costs: costs are notional costs which do not involve any cash outlay. For example, interest on capital which is not actually paid. G. Capitalized cost: these are costs which are initially recorded as assets and subsequently treated as expenses. H. Product costs: these are the costs which are associated with the purchase and sale of goods. In the production scenario, such cost associated with the acquisition and conversion of material and all other manufacturing input into finished product for sale. I. Opportunity cost: this cost refers to the value of sacrifice made for benefit of opportunity foregone in accepting an alternative course of action. Example, interest on bank deposit, if the company financed its expansion plan FD withdrawal. J. Out-of-pocket cost: it is the total cost, which involves cash outflow. This cost is considered while fixing selling price during recession, make or buy, etc. K. Shutdown cost: those costs, which continue to be incurred even when a plant is temporarily shut down. Example, rent, depreciation, etc. L. Sunk cost: historical costs incurred in the past are known as sunk cost. They play no role in current decision making. Example, decision relating to replacement of a machine, written down value of the existing machine is a sunk cost. M. Absolute cost: this cost refers to the cost of any product, process, or unit in its totality. N. Discretionary costs: such costs are not tied to a clear cause and effect relationship between input and output. Example, advertising. O. Period cost: these are the costs, which are not assigned to the product but are charged as expenses against the revenue of the period in which they are incurred. Example, selling and distribution expenses. P. Engineered costs: these are costs that result specifically from a clear cause and effect relationship between inputs and outputs. Q. Explicit cost: this cost also known as out-of-pocket cost and refers to cost involving immediately payment of cash. Example, salary. R. Implicit cost: this cost does not involve immediate cash payment. Example, notional rent. Different methods of costing has been developed in different industries according to their nature of work. Single or output costing: this method of costing is generally used in industries where only one product is produced. Example, brick industry. Under this method the cost of the single product is ascertained. Batch costing. Batch represent a number of small orders passed through the factory in batch. Each branch is treated as a unit of cost and thus separately costed. Cost per unit is arrived at by dividing the cost of the batch by the number of units produced in each batch. Job costing. In this method, cost of each of ascertained separately. Job costing is suitable for organizations such as printing press, motor workshop, etc., where work is undertaken on receiving customers' orders. Contract costing. Share the cost of each contract is ascertained separately. It is suitable for firms and engaged in the construction of building road, bridges, etc. Process costing. Under this method the cost of completing each stage of work is ascertained. In mechanical operations, the cost of each operation may be ascertained separately. This type of costing is called process costing. Operating costing. It is used in the case of concerns rendering services like the transporter, supply of water, etc. Multiple costing. It is a combination of two or more method of costing outlined the above. Techniques of costing. 1. Uniform costing. When a number of firms in industry agree among themselves to follow the same system of costing in detail, common terminology for various items, and they are said to following a system of uniform costing. Advantages of uniform costing. 1. Cost comparison among these firms. 2. It is found useful when tax relief or protection is sought from the government. 2. Marginal costing. It is defined as the ascertainment of marginal cost by differentiating between fixed and variable cost. It is useful to ascertain effect of changes in volume or type of output on profit. 3. Standard costing and variance analysis. It is whereby standard cost are predetermined and subsequently compared with the recorded actual cost. 4. Historical costing. It is the ascertainment of cost after they have been incurred. Post-costing. It means ascertainment of cost after production is completed. Continuous costing. Cost is ascertained as soon as the job is completed or even when the job is in progress. 5. Absorption costing. The practice of charging all cost, both variable and fixed, to operations, processes or products. This is different from marginal costing where fixed costs are excluded.